For the longest time, your Sacco has remained a very integral part of your investment and saving platforms, giving good returns on both the share capital and other saving vehicles. In some quarters, they have regarded the good returns that we are getting from our Saccos as unrealistic because they lack better words to describe the good returns that we get from the dividends that we are getting from our share capital and the interest rebates that compensate us for the high interest rates that we are paying on our Sacco loans. High interest rates because Saccos, we use our own capital. The monies that are on lent to us as members, they are accumulated or collected from our own contributions, and therefore our interest rebates high enough to be regarded by those fellas as unrealistic. They are just a compensation or a return. We are being refunded for what is felt to be high interest rates that we pay on our loans, and that is the reason why this interest is called a rebate. A rebate, by definition, is an amount that is refunded to a borrower where it is felt that this borrower paid higher than what should be the right amount of interest. It also doubles as a return on those members who have contributed towards building the working capital or the fund that is used to lend to the other members. And therefore, that becomes a return to their investment because Saccos, just like any other player in the financial institution, Sacco is an intermediary between savers, those members who have money to save, and the Sacco makes it available to the other members who are willing to use those amounts as capital to finance their economic activities or their consumption because Saccos will give loans for both production and providence. Looking at this schedule confirms the resilience of Saccos as good investment opportunities and good parking points for our savings. The schedule indicates that on dividends, where dividend specifically, in order for us to shed more light on what these returns that we are getting from Saccos are, generally across the Sacco sector, we refer to every return that we are paid from our Sacco as dividends. But in general, this we call dividend constitutes of two things. And one is what you rightfully now call a dividend, and the dividend is a share of a company profits or surpluses by its members. In this case, a member, upon contributing what is regarded as the minimum share capital, which equates or makes all members of a particular Sacco as equal owners of the Sacco. The part of the surplus of the Sacco that we share as owners of the Sacco is that what we call the dividend. And as per this schedule, the Saccos have been paying good dividends. We have Saccos that are giving us as high as 20%, 19%, 18%, 17%. We have as low as 9% for those newer Saccos that are yet to build their muscle in the finance sector. These are some of the returns that are being regarded as unrealistic, but Saccos are regulated by SASRA, and part of the regulation requires that Saccos employ CEOs and top management who are professionals, in particular certified public accountants. And these are personnel who ensure that Saccos in their reporting structure, they adhere to the international financial reporting standards in order to make sure that their disclosures give us a true and fair view of the financial position of these financial institutions. And therefore, at this point, it's good now we realize that the returns that we are getting from our Saccos are not unrealistic, but they reflect the good performance in the financial business of our Saccos. In the second column, we have the interest rebate rates, which also significantly are good returns on members' deposits, comparing to the interest rates that are charged on the member loans, getting back a return that is way over 90% of what you paid or is interest on your loan, that is a good compensation for the interest that we are paying on loan, meaning that a Sacco can afford, or the net effect of a member who has a loan from the Sacco and you are getting that dividend, we can easily say that Saccos are able to give you a loan at a net interest rate on that loan of 2%, 3%, or 4%. And that is meant towards achieving the core mandate of the Saccos, that is of improving the social economic welfare of the members. It also reflects the resilience and vibrancy of the sector if we consider Saccos like Mwalimu Sacco that was beaten so much financially by their one-time Eve transaction in acquisition of Equatorial Bank from Merallis, which rebranded to Spire Bank, which threw that Sacco into loss-making institution, but it has bounced back, and in 2024, which is 2025, the Sacco has paid a 13% dividend on share capital and a 10% on the members' deposits. It can also reflect when you look at Arambe Sacco's new highs of 15% in their dividend on share capital and 9% on members' deposits. We will look at the new occurrence in the Saccos, the real numbers of what was lost by the Saccos and what the Saccos are doing, and most important, where you need to put your money come 2025 onwards in your Sacco. We'll be looking at all that after 3 seconds short break. So in the meantime, as always, give a like to this video and engage shaping the discussion about Saccos in the comment section. And because this video has a value, share it to another person or group of persons in order to help this channel achieve its objective of sharing financial literacy to as many people as possible. See you after 3 seconds short break. Welcome back, and to start us off, we need to shed more light on this animal Cusco and the numbers, how they look like, their effects, and what is being done with the Saccos. And of using this schedule, you notice that the figures have been shown in thousands. So you read in millions. So IG Sacco had in Cusco 588.7 million. We have Balozi Sacco having 437 million. Mwasibu Sacco has 480 million. Kimisitu 353 million. All the way down to Tembo Sacco having 115 million. Amref Sacco having 90 million. LSK has 19 million. Ushuru 7.8 million. And Nation 12 million. Something that is very important to note is that the architecture of the fraud that happened at Cusco happened over a long period of time. And like it is always, for this kind of information to come in the public limelight, there should have been a disagreement between some parties somewhere. And what happened is that Sasra was pushing for Cusco to have its segment of financial business or services to be regulated by Sasra, even if it is not provided for under the Sacco Societies Act, because the Cooperative Societies Act covers incorporation of the primary Saccos and does not include the regulation of the apex or union Sacco. When that disagreement between Cusco and Sasra protracted, because Sasra in its effort wanted to protect its members who are the primary Saccos, the Saccos where you and I are members, because Cusco is a Sacco for the Saccos. That battle led to Sasra writing a letter to the Commissioner of Cooperative Societies to look into what was happening at Cusco, because by law, primary Saccos are regulated, and the law requires that investments that are going to be done by the primary Saccos outside the normal mandate of lending to their members would require at least up to 60% to be invested in government securities, and only a maximum of 40% can go to unregulated institutions outside the government securities of treasury bills and bonds. And that was the concern by SASRA in calling Cusco to be under its regulation to protect the primary Saccos. And because Cusco knew what was happening and Sasra had an eye on what had seen what was happening, Cusco did not want Sasra to regulate Cusco. And therefore, Saccos were aware of what was happening because Sasra was pushing Saccos to reduce their investment in Cusco up to the required limits. And for that reason, Cusco felt Sasra was the one that is pushing their members who are regulated by Sasra not to put more money in Cusco. But that was good for the Saccos. And in essence, when you look at the financial statements of these Saccos, what was being invested in Cusco were not member deposits. These were the retained surpluses by these Saccos. And for that reason, Saccos are still stable, apart from the few like Metropolitan Sacco that has its own challenges and problems, and that is the reason why it has been declared insolvent. In the case of our Saccos, and as per these numbers, as per this schedule, and considering what Saccos have declared as their surpluses over the years, it is the retained profits, the balance of surplus that has not been shared as dividend and interest rebate, that is what was being invested by Saccos in Cusco. For that reason, and as a way of disclosure in reporting, this has to bring in the question or the issue of IFRS, International Financial Reporting Standard number 9, which requires full provisioning of losses. And in the case of the Saccos, to find a way of reporting in line with that standard, but without interfering with the ability of the Saccos and interfering with the members. And the only way to interfere with the members was a case where a Sacco would provide for the entire amount perceived or expected to be lost in Cusco, and for that reason, then deny members their returns in dividends and interest rebates. And that is the reason why it was advised as prudently that the Saccos need to provide for the amounts expected to be lost under Cusco in bits over years. Some Saccos, like Steamer Sacco, providing for the entire amount because their returns could accommodate that. And also the amounts that were sitting as retained earnings in their balance sheets and the capital was enough also to take care of those amounts. And therefore, these amounts do not pose any danger to our deposit-taking Saccos. And for that reason, Saccos will continue performing and giving us our good dividends. The second important thing is now to look at the opportunities that are available in our Saccos for our investments. And this small schedule outlines 4 places where we put our money in our Saccos. And remember, to shed more light, we have 2 main types of Saccos. We have the BOSA Saccos. These are Saccos that are supposed to engage in financial services where the amounts invested by members as way of deposits and share capital are not withdrawable or transferable so long as one is a member. Then we have the FOSA Saccos, which is an advancement in the BOSA Saccos through the regulation by SASRA, where these Saccos are given another layer of business where they offer banking-like services. And in FOSA section, that is supposed to deal with investments or banking-like activities where the amounts that are deposited, saved by members, they can be accessed by members anytime that they want or as per the provisions or properties characteristics of the specific product. And that's why you'll find your junior accounts, the accounts where you are saving for your children, they are domiciled in the FOSA section and not in the BOSA section. That's why you'll find your golden account for those Saccos that have created saving platforms for retirements. They are domiciled in the FOSA business and not part of the BOSA business, because those amounts are available for access by the members as per the provisions of those particular products. That will give us these four areas where you can put your money. And one is share capital. Share capital is permanent resources for the Sacco. Once you have invested in share capital in the Sacco, it is the same as when you buy shares in any other company. You cannot withdraw share capital from a going concern, a business that is still operating. Share capital can only be done away with in the event you are liquidating, you are doing away with a company. And therefore, the same way we cannot withdraw shares, our share capital in companies, but we sell it, or we sell that investment through the Nairobi Stock Exchange. And for companies that are not listed in the stock exchange, there is a way that we sell those shares to other persons. For Saccos, the same way, that capital forms part of the core capital, permanent capital of the Sacco, and therefore, in the event a member ceases to be a member of the Sacco or wishes to withdraw his or her membership from the Sacco, then for the investment in share capital, that is supposed to be sold to another member, because this law operating, or the law that regulates operation of Saccos can only transact with members, their own members. Therefore, the shares in a Sacco cannot be sold to another person outside the Sacco, but an existing member. So unless that other person joins the Sacco as a member, then the transaction can take place. That member will have to look for an existing member to buy that share capital. But on the other side, a member can also retain their share capital as a form of long-term investment, where you'll be expecting the annual dividend payouts as your compensation. It's a form of dividend, it's a form of investment return. And most people will sell their share capital not because they are not getting the dividend, but because their investment is so small that when they consider what is being paid out as dividend, they don't see any reliability in that amount. But you have an option of building up your share capital, except for the few circles that peg a maximum beyond which you cannot exceed. Many circles will allow you to grow your capital. And this is the best way to invest in share capital. Instead of putting your money directly into a share capital account, you purpose to buy share capital from the withdrawing members or long withdrawn members. Because when you are buying that share capital, you are not regulated in any way. You negotiate for a price. And because of that, you are able to get a tax-free capital gain from that purchase. An example, a withdrawing member who has 50,000 in his share capital account and wants to sell that share capital is a willing buyer buying for value. You negotiate. And for example, my case, I don't buy share capital in excess of 50% of what is in your account. So if I buy at 20,000, I give out 20,000 and that 50,000 get transferred into my account. I've already gained 30,000 out of that investment, which is by capital gain. And it will not be, it doesn't attract any tax because the capital gain is not much regulated within the Sacco sector. That is a transaction between me and purchasing member and the withdrawing member. Then look at the dividend payout. Take an example of a Sacco that is paying 20%. Of that 50,000, come the end of the year and I've been paid 20% of it, I'll get a return of 10,000 minus a 5% withholding tax on a dividend. So what I'll get as the net amount is 9,500 after tax. Considering that I gave out 20,000 to purchase that amount, it means it will only take me 2 years to recover my total investment. And therefore, from the third year onward, I'll be getting income against an investment that are fully recouped. And that is the basis that you need to look at your investment in share capital. Look at the dividend payout rate from your Sacco. An example, like we have used the 20%. Use 72 rule to determine the number of years it will take you to recover the amount that you have invested in that share capital. You get 72 divided by the rate, and also factor in the capital gain in case you have bought from other members. And assuming that you didn't buy, you are looking at how long it will take you to recover the amount that sits in your share capital account. Taking 72 divided by 20 as an example, that one will give us 3.4 years, meaning that by the fourth year, we will have recovered everything that we have invested in our share capital through dividend payouts. Then, assuming you are a good investor and you have applied the principle of compounding, meaning that the dividend that you are getting, you are moving it to another account for it to start generating money for you. So it's possible to make sure the returns that you are getting from the Sacco are compounded. So having that amount, maybe you wire it to another money market fund where it starts also generating money. It means by the end of the fourth year, you will have in the money market fund an amount that is more than what sits in your share capital account. Then from that on, the share capital account will keep on giving you those annual dividends as the money market fund also gives additional returns because of compounding. The second account is the alpha BOSA deposits. We have a lot of mix-up in language within the Sacco sector. We will talk of savings, others will talk of deposits, but generally, deposit is any amount that you present to a cashier or the teller for purposes of crediting any of your savings accounts. That is what generally a deposit would be. But when it comes to Sacco, we distinguish what you are putting into your BOSA account and FOSA account. In the BOSA account is where we retain the word deposit. The savings, the amounts that you have accumulated in your account that you use to borrow against or use to guarantee other members their loans as guarantee or collateral, security for the loans. That is what we retain to use the word alpha or deposits, and it forms part of the BOSA business, in which case we have said any amounts that are any account that is domiciled within the BOSA system is not accessible to a member unless you are withdrawing from the Sacco, save for share capital that is not withdrawable but transferable to other members. In the deposit segment, you have a limitation, or you are limited to the extent of the ability to borrow. So the loans department always will determine your ability to borrow as based on your incomes and depending on the loaning policy of your Sacco. So this is an avenue that one can also use to build up investments. The return from the deposits for majority of Saccos is lower than the return that you are getting on the share capital as a dividend. And this is a rational, considering that these deposits you have also borrowed against them, and you are either arbitraging elsewhere or you have used such borrowed amounts to build yourself economically in other opportunities. And therefore, the rebate, the reason why the return you get on your deposit, the interest is referred to as a rebate, is a compensation. It's like a refund on your interest that you are paying on the Sacco loans. And then net, you realize that in some cases, you are using loans at a cost of 2% or 1% if you consider the interest that you are paying on the loan and the amount that you are getting as a return or compensation as interest rebate. For those members who are not borrowing, then that becomes an investment because you have provided your money, resources for lending to other persons. And that's why now you get your interest rebate as a return on that investment. So it's also a good place to invest, but it is a choice. If you are not borrowing against those money, you can maintain a minimum contribution towards the deposits as you build up on your share capital. But remember, deposits can be accessed by you anytime you want to pull out from the Sacco. The third place you're investing your money in a Sacco is in FOSA savings or FOSA accounts. We have your salary accounts within FOSA. You can open a business account in the FOSA section. You can open an ordinary savings account in the FOSA segment. You have your junior savings accounts. You have your golden retirement accounts within the FOSA system. And those are opportunities, but these accounts merely operate not just like ordinary bank accounts. And therefore, in most cases, a salary account or ordinary as a checking account for those who would want to obtain further loans because the normal BOSA loans, their recovery through payroll systems is governed by their third rule regulation. If you want to take a loan that exceeds their third rule, then you have to wire your income or your salary to your Sacco FOSA, a salary account on which you can apply for FOSA-based loans for your own production or providence. Then those accounts in the FOSA section don't attract as huge returns compared to your share capital and deposits. The last and the fourth area where you can invest in a Sacco is the fixed deposits account, which also operate under FOSA section. But as we have discussed on other videos on the importance of maximizing your returns, the fixed deposit accounts within Saccos are more or less the same as what we have in banks. And if you take a keen look on the financial reports from your Sacco, you will notice that one source of interest income to your Sacco is from investing in money market funds. So your Sacco will collect what you have invested in their fixed deposit vehicles, which merely at 8%, 7%, then invest outside in money market funds that are giving returns as high as 15%, 16%, now 14%, then that difference remains with the Sacco as a profit. Why not consider investing what you would otherwise put in those fixed deposits accounts within a Sacco outside in a money market fund? Because these funds nowadays are available for investments by individuals. So I will not advise you put your money in a fixed deposit account within a Sacco when we have better opportunities outside the Sacco environment. Lastly, but not the least, Sacco remains an integral part of our investments, and at least it should form part of your investment portfolio so long as you are within the working age. On retirement, it will depend on the amounts that you have invested in the Sacco by the time you are retiring, and also considering how much liability you owe to the Sacco. If you are retiring and you have substantial amounts that have been invested in the Sacco, you will have good returns in the dividends. You can maintain levels of deposits, but you can also have those amounts domiciled in drawdown accounts that are paying you better returns when you are accessing those future returns to finance your retirement lifestyle. Thank you for watching and see you in our next video.